Hi, everybody. Thomas here, looking forward to looking at another stock and trying to analyze it on the basis of whether or not it represents a good buy right now under current market conditions or whether or not it's a sucker's bet. Stock on deck today is Tesla, TSLA. Let's dive straight in. We can see that in 2022, the stock followed a pretty clear downward trend all the way down to a bottom to start 2023 down at around 100. It started rallying from that point, has been following an upward trend since then to its current price at around $265 per share. So if you've been following the stock throughout 2023, this has been pretty interesting to watch. If you've actually been in it, then you've made a healthy amount of money, which is really nice. But if you're trying to consider the stock on the basis of whether or not it might make a good investment today, there's a lot of different questions to consider. The first thing that I like to pay attention to, as always, are my charts and the stock pattern. I'm looking for either a bullish level 1 or bullish level 2 setup with the stock above both its 20-week and 200-week moving averages. That means that what I'm actually looking for in this case would be a bullish level 1. I'll just say BL1 here. Sorry for the bad handwriting. Bullish level 1 means that my 200-week moving average is going to be flat to going up. In this case, it's going up. The 20-week moving average, under ideal circumstances for this pattern, will have been tracing down, beginning to flatten, possibly begin to curve up. That happened for Tesla in a significant way at the beginning of this summer. And that would have provided the optimal pattern here as the 20-week moving average approached the price area of the 200-week moving average, as you can see. The other thing that I pay a lot of attention to at that point is the price pattern that comes from the candlesticks, looking for some kind of a hammer formation that looks something like this. Under ideal circumstances, it may look a little bit like this. It can even be inverted like this, but both of these are examples of hammer candlestick formations and can provide a good signal that bullish momentum is beginning to move in our favor. The closest example we have for that is down here at the very bottom of the stock's trend here in May of this year, but the candlesticks that followed were clearly bullish. We can see what we would call then engulfing candlesticks in the next couple that look something like this. They were larger than the candlesticks that preceded them. So those were good confirmation of the initial hammer signal, and that provided the good indication of a useful entry point right here. So that would have been the optimal time. The fact that the stock is significantly above that level now, we can see it up here around 265, lifting well above the 200-week moving average, and the slope of the 20-week moving average also picking up quite a bit of momentum here, really starts to beg the question of how long can it keep going? And so there's a lot of different questions about that. It means that right now, Tesla does not fit the pattern for a bullish level 1, bullish level 2 kind of a setup that I would ideally be looking for. The stock is following an upward trend through this year. This bounce that began a little over a month ago, right along the 20-week moving average, could have been an indication that momentum was starting to pick up again. However, the stock is also only about $10 away, roughly, from its last pivot high, which occurred about 2 months ago. That suggests that the stock's short-term upside may be kind of limited and starts to beg the question of what return to risk looks like. So that's just a really quick look at the technical pattern and describes what may be a situation that doesn't quite fit our ideal. The next question, as always, is whether or not the stock's fundamentals point to a company that is well-run and therefore a value proposition that might suggest that the stock could be a good bargain, even with its price increase since the beginning of this year. So let's take a look really quickly at what those metrics are. I like to pay a lot of attention to the metrics that are shown here. For my fundamental analysis, I pay a lot of attention to the pattern of free cash flow growth over the last year and the last quarter. The same for the company's balance sheet. Not only is there healthy cash compared to long-term debt, but is cash increasing while debt continues to be manageable? Net income and revenue comparisons help me to analyze the profitability of a company's general operations, and whether or not they pay a dividend is a major factor in my decision-making process for the stocks that I like to use for my Rebel income trading system. The valuation side of my analysis is based on price to book and price to cash flow analysis compared to the levels that the market has historically shown to be pretty normal for the company. If those levels are below those historical norms, then there's a good chance that the stock could be offering an attractive bargain right now. So let's go ahead and take a look at what those numbers actually are. We can see here that in this case, there's some good things and perhaps some things that are not quite as good. Free cash flow is a little over 6.1 billion, and by itself, that's pretty good. It is interesting, and to be honest, a little bit of a concern to see that over the last year, free cash flow has decreased from about 9.8 billion to its current level at $6.1 billion. It's also lower over each of the prior quarters. We can see 9.8 to 8.5. So that's a decrease. We see 6.7 to 8.5 billion. That's a decrease. 6.7 billion to 6.16 billion, also a decrease. So these are all negatives in terms of the actual free cash flow growth pattern. We really want to see these numbers increasing. Free cash flow yield, this is a measurement that I simply use to compare the current free cash flow number to company's market cap, and this is relatively minimal right now. It is worth mentioning that only just a few years ago, Tesla was consistently reporting negative free cash flow on a quarterly as well as an annual basis. So they have seen their operation shift to a significantly more profitable position, but the last year is showing some declines that are a concern. Cash, on the other hand, is extremely healthy. We have more than $23 billion in cash and liquid assets compared to 21.1 billion a year ago and 22.4 billion in the last quarter. It's also interesting to compare cash against long-term debt, and we can see that Tesla has no long-term debt on their books. That's something that is very interesting. It means the company has a lot of financial flexibility, not only to reinvest in its business, but also to consider ways to return value to its shareholders. And I'm bringing this up right now because the fact is Tesla does not pay a dividend. You can see that's $0. That means that this is a company that would automatically be disqualified from the Rebel income trading system simply because they don't pay a dividend. But the ironic thing is that they have more than enough cash to actually pay a dividend. If they were to simply approve a dividend of 1% on an annual basis, it would be about $3 per share. That would represent a capital outflow each year of about $9 billion. Between their free cash flow and their cash and liquid assets, it's clear that they have the financial ability to do that. They simply have chosen not to. So that, to me, is not necessarily a red flag. It doesn't mean they are fundamentally weaker than others. It simply means that this is a company that I'm not going to want to work with. I prefer to focus on companies that like to return value to shareholders in the form of dividend distributions. Net income to revenue is healthy, but also declining. We can see 13.01% over the last year compared to a little under 11% in the last quarter. This is a downward pattern from the trailing 12-month number to the most recent quarter that validates the declining pattern of free cash flow that we just talked about a moment ago. So all things considered, there's some fundamental strengths. The company's balance sheet is obviously very, very healthy. There's some deteriorations in profitability that suggest certainly that the effects of inflation and cost pressures related to supply chain concerns and a variety of other issues are weighing on the company like a lot of others in the marketplace right now. In terms of its value proposition, the company's fair value target that I like to calculate based on price to book and price to cash flow is a little bit higher. Fair value target is around $276.80, a little bit above the stock's current price. at around 267. Even so, that really only suggests the stock has about 3.5% upside from its current price, which doesn't exactly mark it as a big bargain right now. Does that mean that the stock is a sucker's bet then? Well, that is a little bit of a different question. So let's take a look, go back to our chart pattern, and let's take a look at what we have. I mentioned already that the stock is starting to approach a prior pivot high that occurred just a couple of months ago up here, probably around 285, possibly $290 per share. I'll just write 290. From the stock's current price at around 265, 267, that means that there is roughly about $25 of upside from that current price if we're just to go strictly based off of pivot analysis, which is a reasonable way to think about upside versus downside. In the same way, if we apply the same method to try to identify where the stock's next support level would be, if it begins to break down and picks up bearish momentum, we can see the 20-week moving average is sitting right around $242 per share. Let's just write 242 there. That means that downside on Tesla in the very near term is around $23 per share. I'm going to put a negative here. So negative $23 per share against $25 of potential upside. So basically your reward to risk, if you were to say, I like this current trend, I like this latest bounce off of the 20-week moving average, and I think it's going to go higher, right now is literally you're looking at about 1-to-1 reward to risk. That's a very low ratio that gives you a very low probability of success. The stock would realistically need to break above this 290 level before you could really even begin to consider it for another buying opportunity. In that case, if that were to happen and the stock were to continue to move higher, its next likely level of resistance is probably going to be somewhere around 325, based on a lot of pivot activity back here in late 2021 and the early part of 2022, which means that there could be upside from this 290 level at around $35 per share. That might be interesting, but the stock has got a ways to go before it even begins to offer that kind of a setup. For all of these reasons, right now, I have to put Tesla squarely in the category of a sucker's bet. Thanks everybody for your time. Hope you've enjoyed this. If you like this video, please go ahead and subscribe to my channel. You'll get a notification each time I release a new analysis video on my channel. Thanks again. Talk to you again soon.